Now, Uganda's central bank raised its benchmark lending rate by 100 basis points to 12%, citing above target core inflation and the need to anchor inflationary expectations. On the line to unpack these numbers, we are joined by Professor Emmanuel Tumisime Mutebile, Governor of the Bank of Uganda. Governor, thank you so much for joining us. Now, talk us through what was behind today's decision to raise interest rates.
Well, the inflation rate in Uganda rose in August because of a sharp supply shock, a food supply shock, the drought, largely due to drought, which has been experienced in many parts of Uganda over the last few months, which has led to food crop prices rising by 16% in August alone. Although food supply price shocks are normally temporary, with food prices subsiding when the rainfall returns, it is still a cause of concern because of the potential knock-on effects to non-food prices.
Do you believe that this raise in interest rates is sufficient to see inflation falling back to the target of 5%?
Well, the main point now really is to ensure that there is an impact on demand in such a way that we can influence expectations of future upward movement in inflation, which might in turn affect wage demands.
Very quickly, Governor, if we look at how this decision impacts on the investor outlook on Uganda as an investment destination, your views on that?
Well, that's a complicated one, but we must, I think, differentiate between long-term investors and short-term investors. Short-term investors will obviously be interested in our raising the interest rate because it will lead to an increase in the interest on treasury bills and so on, which should interest short-term investors from abroad. But obviously, for long-term investors, it depends upon what the general impact of this on credibility and the investment climate would be.